Hello everyone, welcome to Avyukta Learning. So today we are going to continue with our chapter 1 in this video. So let's have a quick recap of the topics which we have read till now. The first one is meaning of accounting. So accounting is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting and communicating financial information. And we saw uh, what are attributes of accounting or process of accounting. And then we saw a question, is accounting a science or an art? And we had few discussion about it. And as the conclusion, uh, accounting is an art as well as a science. So this is what we concluded after our explanation in the previous video. And then we saw the branches of accounting. So branches of accounting has three parts. First one is financial accounting. Second one is cost accounting, and third is management accounting. And then we started the topic bookkeeping. So bookkeeping is part of accounting. So bookkeeping is the process of recording financial transactions and events in the books of accounts. That is, bookkeeping involves identifying transactions, measuring them in terms of money, recording them in books of accounts, and classifying the recorded transactions. So uh, these are involved in the process of bookkeeping. And we saw the difference between bookkeeping and accounting. So as I said, in many places people used to interchange the word bookkeeping and accounting. They think that both are same, but no, both are not same. Accounting is wider term than bookkeeping. So bookkeeping is part of accounting, and bookkeeping is primary stage and accounting is secondary stage, and accounting starts where bookkeeping ends. So try to remember these based on the basis given in this tabular column. And then we saw the meaning of accountancy. So accountancy is the knowledge, where accountancy is a knowledge and accounting is inside accountancy. So accountancy has principles of accounting and the methods how we need to do accounts. All the methods and principles, all the assumptions are given under the head accountancy. Under that, using those principles and assumptions only, we do accounting. So accounting is a process or action, whereas accountancy is the knowledge. So I hope everything is clear till this topic. So today we are going to see objectives of accounting. So whatever subject we learn, each and every subject has some desired objective to be achieved. So the same way accounting also has few objectives. So let's see one by one. So objective of accounting. First objective is record of financial transactions and event. The objective of accounting is to record financial transactions and events of the organization in the books of accounts in a systematic manner following principles of accountancy. So the first objective is to record all the financial transactions and events in the books of accounts. Books of accounts starts with journal and then ledger, and then we will prepare trial balance, profit and loss account, and balance sheet. So all these we will prepare. So our main objective, the first basic objective, is to record the financial transactions and events in the books of accounts in a systematic manner. So systematic manner, I told why we use the word systematic manner in our previous lectures. So how they record, they will use the principles of accountancy. All the principles of accountancy we will be reading in the upcoming chapters. So by following those principles only, we will prepare financial statements. And this is the first objective. The second objective is to determine the profit or loss of the particular company. So everyone are interested to know the profit earned or loss incurred by the company for each accounting period. So our like our calendar year starts from January and ends at December. And the same way we have our academic year, the same way we have our financial year also. So our financial year starts from 1st April of current year to 31st March of next year. So, for example, for this year, the financial year will be 1st April 25 to the 31st March of 26. This is the current financial year, upcoming financial year. So this financial year only we will call it as accounting period also. So because so for each and every accounting period we need to determine the profit or loss. So that is known as financial performance. To determine the financial performance, that is profit or loss for the accounting period. Accounting period is nothing but 1st April of current year to 31st March of next year. That is our accounting period, which we will call it as financial year. And the third objective is to determine the financial position, whether we are whether our financial position is good or bad. We need to know that. It is known from the balance sheet. So balance sheet is prepared to know the financial position of the company. Financial position of the business is relevant for uses of income statement. So from the financial position of our company, we can know whether the company can sustain for few more years, or it goes on, or there are less chances for the survival of company, like the company should be closed immediately, it should shut down immediately. So this is the financial position. With this we will find out the financial position of the company. So that is the main third objective of accounting. Next is fourth, assisting the management. So as I said, financial information helps management to take some informed decision. They can control the production activities. They can control the cost. They can prepare budgets, and they can see the sales forecast. Sorry, sales forecast. They can devise new schemes into the organization. So that is the fourth point. To assist the management by providing financial information to it, management requires financial information for decision making, exercising control, budgeting, and forecasting. So this is the fourth objective. Next objective is communicating the accounting information to users. So to provide accounting information to the users who analyze them as per their individual requirements. So there are many users of accounting information. The That will be our last topic of this chapter, uses of accounting information. So there are many uses of accounting information. For example, in the previous lecture I have explained about the bank example. So bank has its own individual requirement. The same way creditors will analyze the accounting information. The same way government will analyze the accounting information. So each one have their own requirements. So only they check the financial information. So it is very important to communicate the accounting information to users. So this is the fifth objective, and the last objective is protecting business asset. To have record of assets owned by business, it helps the management to protect the asset and exercise control. So we need to have a check upon assets. Assets are nothing but our stock. Stock is our current asset, and land, machinery, and other furnitures and fixtures, whatever asset we have, we need to have a track of our asset, or else what will happen is, uh, so there will be possibility of theft, some fraud will happen. So we need to protect our asset. So some if we don't have the number of stocks we have in our godown, what will happen? Some many theft will happen in our godown itself if we didn't have a proper track of inventories. So it is very important to record the assets owned by the business. And uh, and also we can exercise the right control over our assets. So that is the sixth objective of accounting. So with this, objective of accounting ends. I hope this topic is clear to you. Now the next comes advantages of accounting. So accounting has its own advantages and disadvantages. So first advantages of accounting is financial information about business. Financial performance during accounting period, that is profit earned, or loss incurred, and also financial position at the end of accounting period is known through accounting. So the first advantage is we can know the financial performance of that particular accounting year. That is our first and foremost advantage of doing accounts. So an, an entrepreneur can know the profit earned by him or the loss incurred by him, and also the financial position of the company at the end of accounting period. So this is our first advantage. Second is assistance to management. The management makes business plans, takes decisions, and exercise controls over the affairs on the basis of accounting information. So the same point. So management, my accounting information gives some assistance. It gives guidelines to management um on taking management decisions, decisions. So that is the second advantage. Third, facilitates comparative study. A systematic record enables businessmen to compare one year's results with those of other years and locate significant factors leading to change, if any. So, comparative study, what happens is if we can compare the financial statements of the current year with previous year's financial statements, so that we can see whether there is any growth in the business, or it is sustaining the same position, or there is any decline. We can compare it, and we can analyze the causes for the growth, so that we can uh, causes for the growth, the reasons for the growth, what made a company to grow suddenly, or if it is sustaining in the same level, is there any scope for its growth, or if it is declining. For example, sales, if there is a decline in sales, we can find out the reasons behind the decline in sales. So uh, this helps the management to take good decisions. So the third advantage is it facilitates the comparative study of financial statements. Now, the fourth facilitates settlement of tax liabilities. Every corporate company should pay income tax on the income earned by them. So, accounting record uh, gives gives the profit earned. The It shows the profit earned or loss incurred. No, from that we can directly calculate the income tax, and we can pay to the government. So there will not be any miscalculation while calculating our tax liabilities. What happens if we didn't maintain financial statements, and we made some miscalculation and our income is shown more than it is actually? So then what will happen? We will pay more income tax. So it is very important to maintain our accounts, and from that correct right income we will pay income tax. A systematic accounting record immensely helps in settlement of taxes like income tax. So income tax is one example. Fifth one, facilitates loan. Loan is granted by banks and financial institutions on the basis of growth potential, which is supported by the performance. Accounting makes available the information with respect to performance. So, financial statement gives the financial performance of the business. So, with that, the bank will decide whether to give loan to this company, that particular company or not. That bank will decide. So, it helps the company to get a loan from bank and financial institution. If there is any growth, and if the company is eligible, if the company is able to repay the loan amount with interest, the bank will willingly give loan to that company. So only they have included it as fifth point. And sixth, evidence in court. If there is any dispute in the court, if there is an illegal battle in court going on, then this financial statements will serve as an evidence in the court of law. Systematic record of transactions is often accepted by the court as good evidence. So these are six advantages of accounting. And next is limitations of accounting. So when there is advantages, definitely we will have some disadvantages. So we have totally five limitations of accounting. So the first one, accounting is not fully exact. Although most of the transactions are recorded on the basis of evidence, such as sale or purchase receipt of cash or receipt of cash, yet some estimates are also made for ascertaining profit or loss. For example, providing depreciation on the basis of estimated useful life and life of asset, etc. So what happens is, uh, see, for example, if we are making entries for sale and purchase, we will have a supporting documents like we will have vouchers, we have purchase voucher, we will have invoice, we will have receipt for cash we paid, we will issue receipt for cash paid by the customers. So we will have supporting documents for all those transactions. But in few transactions, as I told, we will take some assumptions. Assumptions are not fully uh, right in all. Fully, it is not 100% correct. So uh, assumptions will assumptions will not give 100% accuracy. So our profit or loss will also not be 100% accurate. For example, depreciation. Depreciation means the if we buy 1 lakh machinery worth 1 lakh and the useful life of asset is 10%, 10 years, sorry, useful life of asset is 10 years, the machinery is useful life. What we will do is, we will do 1 lakh, sorry, 1 lakh divided by 10 years. So this rupees 10,000 we will charge to profit and loss account every year. We will not charge the whole 1 lakh in 1 year itself. So we will charge 10,000, 10,000 every year. So this useful life of asset is there, no? The asset may come for more than 10 years or less than 10 years. That we don't know exactly how much useful life will the asset have. So we are just estimating the useful life of asset. That is not the actual period. Actual will be different from the estimation. So maybe the actual life of asset will be 8 or 7 years, or it may also go beyond 10 years, that we don't know. So this is just an estimate. So whatever calculations we are making based on estimate will not be 100% accurate. So only they are. So the first limitation is accounting is not fully exact. So remember this example, providing depreciation on the basis of estimated life of useful life of asset. So this is the first limitation. Now the second limitation, accounting does not indicate the realizable value. The balance sheet does not show the amount of cash which the firm may realize by the sale of all the assets. The balance sheet does not show the amount of cash which the firm may realize by the sale of all assets. So the balance sheet will show the only the current value of the asset. For example, the balance sheet shows that a machinery, the value of machinery is 90,000. If I sell the machinery in market, will I get the whole 90,000? The answer is no. No. Always we will get the amount lesser than what we have in our books. Like that means we will always recover the below 90,000 only for that particular machinery. So that is known as net realizable value. Net realizable value means the value which I will get by selling that machinery in the market, that machinery or that particular asset in the market. So that is the net realizable value. This is because many assets are not meant to be sold. We cannot sell all the assets what we have in our business. Some are not useful at all. Some we have to dispose it. There is we cannot get any realizable value by selling it in the market. So few machineries can be sold, few cannot be sold in the market. So that is what they are saying here. This is because many assets are not meant to be sold. They are meant for use and are shown at written down value that may have been written off. So that is the second limitation. And the third limitation is accounting ignores the qualitative element. So you remember in our first video lecture, I have said that accounting records only financial aspect of the financial aspect of the business. It will not record any non-financial information. I have said that Mr. A is an employee. The skill of Mr. A will not be included in financial statement. The salary paid to Mr. A only will be recorded in the financial statement. That example I told you. So that is what is given here. Accounting ignores the qualitative elements. Since accounting is confined to monetary matters only, qualitative elements like quality of staff, industrial relations, and public relations are ignored. So, this is the third point. And the fourth is accounting ignores the effect of price level changes. Accounting statements are prepared at historical cost. Money as a measurement unit changes in value. Unless price level changes are considered while preparing financial statements, accounting information will not show true financial results. So, we will record all the transactions at historical cost only. For example, there is a company uh, on 1 October 1st, 2024. It bought a furniture worth rupees 2 lakhs. Okay. So in the books of accounts, we will record rupees 2 lakhs on 1st October 2024, and from this only we will provide depreciation. From this uh, amount, from this value only we will provide depreciation every year until the useful life of asset. And now in the market, the value of same furniture is increased, and the value now is rupees 3 lakhs. So the actual value of furniture now is rupees 3 lakhs. But what we will do, uh, this is for 2025. What we will do is for 2025 financial year also we will record the depreciation. We will charge depreciation on 2 lakhs only. We will not change. So this is known as so this price is known as historical cost. So at what value we bought, that is known as historical cost, and this is the current fair price of that furniture. So this we will not consider. We will only charge depreciation. We will always do our financial transactions using this historical cost only. We will not consider the change in price each and every year. We will not change that. So that is what is given here. Accounting ignores the effect of price level changes. And another case is in the year 2026, the furniture's value may go down to rupees 1,50,000 also. Then also we will not reduce our value. We will just charge depreciation on this rupees 2 lakhs itself. So there we will not give effect to the price level changes in our books of accounts. And the last limitation, accounting may lead to window dressing. The term window dressing means manipulation of accounts so as to conceal vital facts and present the financial statements in such a way as to show better position that than what it actually is. So window dressing means manipulation. So often accounts will get manipulated will get manipulated because if the company is a loss making company, for example, the banks will not be ready to give loan to that particular company. So and also there will not be any shareholders. No person will be interested to invest their amount in their money on buying that particular company's shares. So to avoid all those things, they will do is they will manipulate their accounts, and they will show that their financial performance is very good, their financial position is very good for that accounting year. So this will happen often. This will happen in the companies. So that is what is given here. Accounting may lead to window dressing. There will be manipulation of accounts. They will conceal many facts to show that company is in better position. So these are limitations of accounting. I hope everything is clear till this. So in the next class, we will start with the topic accounting information and types of accounting information. So I hope every topic is clear till this. If there is any doubt, please post it in the comment section. And also please like, share and subscribe the YouTube channel Avyukta Learning. Thank you so much.